So, we've had some interesting developments in the whole financial sector and, the U.S. economy in general. We had the jobs report come in, and we added more jobs this month than the last month, and then the month before that. But unemployment is up because, even in spite of that, people who are self employed just aren't self employed anymore. And we added somewhere around 330,000 jobs this month, but our unemployment figure went up. And we are approaching that like 3% range, I believe, which is still really low on a historical thing. And I think they want to push it to closer to 4.5%, 5%. And then the Fed will start backing off on the interest rate hikes, which the FOMC meeting is coming up the second week of June. So, in about something like 10 days from now, we'll see if they do another interest rate increase. And I think the bet is on the whole hop situation where they pause for one cycle and then they raise the next cycle. But who knows? With the unemployment up, I don't know. Inflation right now is coming in somewhere around 5%, maybe 4.8, something like that, depending on which number you want to look at. So, who knows what they'll do there. And then, of course, we have the debt ceiling. The bill got passed, unsurprisingly. It didn't go back to the Senate, or it didn't go back to the House. It passed the Senate. And Biden, at this time, has either signed it or he will be signing it later today. I don't know. He can't not sign it at this point. So that's a done deal. I haven't checked the stock market. I'm sure it rejoiced and all that stuff. I think the interesting thing to watch is still going to be the bank stocks, especially if we have another rate increase. I think they'll get trashed again for a lot of reasons. One, if you can then buy treasuries, if that rate starts climbing up above like 4.75 and such, like, why wouldn't you just do that instead of a different, like, safe stock? Why wouldn't you just buy the guarantee instead of just buying some other, like, dividend stock or something like that? Well, one reason you would maybe do that is that you have the promise, or I wouldn't call it a promise, but the expectation that the dividend will increase over time, and that maybe you're getting like a 2.8% this year, but maybe next year they raise it. Now you're at like 2.85 and 2.9, 2.96, and 10 years later you're getting closer to like 3.5%, 4%. 10 years later on that, your yield on cost is maybe closer to 4.5%, and it just kind of keeps going up. And if you're young and just holding on to this, you're getting that, and plus the stock price itself is appreciating. So money might still stay in some of the stock market, but there's also the point of, well, if I think the stock's going to go down, why wouldn't I buy a 1-year treasury bond? If I think it's going to be lower in a year from now, I still make my interest on that, and then I can jump in when the stocks are lower, and that's a fair argument. And then there's the other one of, well, why not just put it in the high yield savings account? It's paying almost as good, and then I'm not locked in, and I can just jump out whenever I want, whenever I feel I want to jump back into the stock market. So I think a lot of money is doing that. And then there's also the thing of like corporate bonds. They pay a lot more than U.S. Treasuries. So why bother with that whole stock price and dividends and stuff whenever you can get a fairly safe, not as safe as U.S. Treasury, but still fairly safe corporate bond that if the treasuries are paying 4.5–5%, those bonds are probably going to be paying 6.5–7% on fairly safe ones, and you might even dip your toes into the not AAA and maybe the A bonds or the triple B bonds, and you might be getting 8–9% on still fairly safe. Like I think the default ratio was like something like 0.7–9% last time I checked on those kind of bonds, maybe 1.1% default. I mean, it's a little bit of risk, but a lot more reward. So I could see a lot of money going into that. The bond market is bigger than the stock market. So until that breaks, or the stock market breaks, or the housing market breaks, we're going to continue to see these increases in the overnight rate, and interest rates will continue to go up unless employment, housing, debt, or stock markets break, which they seem to be just chugging along with a little bit of unstable insecurity in them here and there with the banking crisis, which I don't know if I'd really call that a crisis. Like, what, 4 banks failed, a couple big ones, but like that does happen. That happens every month. It's nothing like 2008. There was something like 200 or so different banks failed. Like, sure, some big corporate banks did fail, and that is kind of a problem, but we're fine. It's okay. Everything is fine. But yeah, main points. We either passed or the bill is on Biden's desk to raise the debt ceiling. Also, we're one of only 2 countries that have a debt ceiling. That's not really a thing in most of the world. So, yeah, that happened. Jobs came in, not great. We added more, but we have more unemployment. So that's not good. Wage growth came in at like 3.4, 3.5, something like that. But inflation's about 5%, so we're all a little poor from that. If you're a working person like myself, that's not great, because that was about, my raise was about 3.5%, so I'm right on par with that. So it didn't just help me a little bit, I guess, help me not hurt as much. Yeah, we're in a recession, what can you say?